Capital structure is how companies finance their operations. This lesson focuses on debt, which is a type of capital structure that involves taking out a loan. Loans are often taken out from banks, but they can come from many sources. And today we'll focus on how these loans can affect a company and what corporate lawyers should know when advising their clients who might be seeking capital from this type of source. This is Module 2 in our series. The first thing we should know is a bit of accounting. In accounting, they refer to something as the fundamental equation, which is assets equals liabilities plus equities. This is important to realize because liabilities, like debts, always add to two columns when we do double entry accounting. When we take out a debt, we add two things. We add to our liabilities in terms of our debt, but we also have to add to our assets in terms of our cash. Because when we take out a loan, we receive cash, but we owe that as an obligation. And so increasing our liabilities is a way to increase our assets, but it is something that we have to repay, as opposed to equities, which we'll learn about when we talk about stock in the next module, which do not necessarily have to be repaid in the same way. Debts are a form of liability, and so for now what you need to know is that when we take on debt, we increase the liabilities in our balance sheet, and with the double entry method, we also would increase our assets in terms of our cash position. There are some key concepts in liabilities that you should know. The closing is the time when the cash transfer is made. This is when the bank finishes the loan. The closing is important because this is the moment when the representations and warranties that we'll learn about in a moment need to be true. Everything is happening as of the closing in most financings. The principal is the amount that is lent. This is the amount that has to be repaid, although the principal must be repaid usually with interest. Interest is paid along with some amount of the principal on a very particular schedule and at a very certain rate. For example, if you take out a loan of $100,000 with a 1% interest per year, simple interest, the first year you'll pay $1,000 in interest for that loan. That's called a fixed rate loan because that 1% doesn't change over time. There are other types of loans where the interest rate floats. It can change according to the U.S. interest rate or the interbank lending rate or a variety of other rates. But when a loan floats or is variable, a variable rate loan can be more risky because now you have interest rate risk as well. Fixed rates can be safer, but they may be higher because banks are accounting for the fact that interest rates may go up in the future. Maturity is another critical date to keep in mind. That's when the principal must be paid back. Some loans require a piece of the principal to be paid back during the course of the lending period. Others require the entire principal to be paid back at the end. In any event, at the maturity date, all the interest and principal is due, and there can be big problems if there's a failure to pay. One problem that may arise is they can take the security for the loan. Security for the loan means that there is some property which can be taken by the lender if the loan is not paid in full, or if there's another default. Another word for security is collateral. A common way you might remember collateral is that when you take out a loan for your house, the house is collateral. If you don't pay the bank the mortgage on your house, the bank can foreclose on your house and take it. It can sell that property in order to get paid back the money that it was owed. There are several terms for liabilities. Sometimes you hear about bonds, debentures, mortgages, loans, or notes. They're all essentially synonymous, although there are slight differences in their usage. Bonds are typically issued by companies, and they're usually issued to the general public and have several terms including par value, which are specific. Debentures and notes tend to be short-term, whereas mortgages and loans tend to be long-term. Mortgages in particular tend to be secured by collateral, mostly real property. Debentures tend not to be secured. It's not important at this stage to know all the ins and outs of all these different instruments, but you should be able to recognize that all of these things and more are types of liabilities. More important for corporate lawyers is understanding the terms in your loan agreement. The loan agreement is a document that corporate lawyers will draw up in order to perfect or complete the loan. there are certain specific terms you'll find in most loan agreements. Representations are statements of fact about the company made by the company that's borrowing the money that are true prior to the closing of the deal. Warranties are similar. There's a bit of a distinction between representations and warranties in British law, but for the most part in U.S. law, representations and warranties are used interchangeably. To the extent there is a difference, you might think of warranties as things that are true as of the closing, as opposed to directly prior. But for the most part, representations and warranties are grouped together and collectively are meant to mean statements that are true immediately before and of the closing moment. Covenants, on the other hand, are things that are going to be true in the future. For example, a representation might be that the company is duly incorporated in Delaware as of the closing. A covenant might be that the company will remain in good standing in Delaware by paying its franchise taxes on time. If a company fails to make good on its covenants, that can be an event of default. An event of default, such as non-payment of any term under the loan, or a failure to keep a covenant, can result in the loan being accelerated, which means that payment is due immediately. A bank or other lender may waive one of these covenants being breached in order to allow the loan to continue being serviced. Some covenants are truly important, while others are, in parlance of business, belt and suspenders, things that are used as protections but are not necessary. It's up to the bank to decide whether or not they want to enforce a covenant, but most agreements provide that if a covenant is breached, even a minor one, the loan is in default, and that can result in a variety of problems. Any failure can result from the following. Illiquidity means there is an inability to pay the debt with cash on hand. Illiquidity is not necessarily a problem in itself so long as the company is able to access more cash before the loan comes due. Insolvency is a bit of a broader term. Insolvency means the company is generally unable to pay its debts. This is more of a problem because it implies the company is not able to access more cash that it would use to pay the debt on time. When the debt is not paid on time, the company is in default. It's a big problem to be in default because now the lender has a variety of remedies it can draw upon. But one thing that it can draw upon that's particularly problematic is bringing the company to bankruptcy court. Often a default can result in a bankruptcy, which is a legal proceeding against the company that has not paid its loans. A bankruptcy court can order a number of things, including selling assets, but oftentimes bankruptcy results in a compromise called a restructuring. A restructuring is an event where the creditors and the debtors agree to change the capital structure of the company, sometimes reducing the percentage of interest rate on the loan, other times extending the term of the loan, or otherwise changing the order of the creditors in order to make it possible for the business to continue operating. Banks oftentimes find a company that is currently operating more valuable than one that needs to be liquidated in bankruptcy. Because a bankruptcy court can also order a company to sell all of its assets and use that to pay off its creditors. But as we learned in our prior lesson, a company is often worth more than the sum of its parts, so debtors will often prefer a restructuring to a liquidation in bankruptcy. If you're advising your client whether or not to take on a debt, here are some key considerations to remember. A debt requires regular payments or repayments of the principal and/or the interest. If these payments aren't met on a scheduled basis, usually monthly, the company can go into default, and then the bank has a lot of power to drag you into bankruptcy court, force a restructuring, or otherwise create a lot of trouble. This bankruptcy risk is not necessary when using equities, as we'll learn next term, because equities do not need to be repaid on a very particular timescale. But the big advantage to taking out debt as opposed to equity is the bank is not an owner. It's just a contract counterparty. Lenders are not owners of a corporation. Aside from the covenants that they insist on in their contractual agreements, they really don't have any rights to control the corporation. So the corporation can continue operating its business as it chooses, without interference, and it doesn't have to ask the bank or other lender for permission. Briefly, who else might lend this money? We'll look more deeply at in Section 4, Module 4, when we talk about convertible notes. For the most part, small businesses get their loans from banks, and sometimes from friends and family. But most of the loans that we'll be working with as corporate attorneys come from large lenders like banking institutions, unless they're convertible notes as discussed in Module 4. Thank you for joining me. I hope you'll tune back in for Module 3, Equities. I'm Professor Seth C. Orenberg. Thanks.